Hello guys, in this video we're going to talk about a very different way of creating an iron condor. So we are going to create an iron condor but not a regular iron condor. So what I'll do is I'll first explain what's regular iron condor, and then we are going to what we are going to create today is that's a bearish iron condor. So first we'll explain what's a regular iron condor and how can you do it in Bitcoin options, and then I'll tell you bearish iron condor, in which scenarios you will be using that bearish iron condor, and then opposite of that, that's what bullish iron condor. So here we have a slightly directional view. Okay, neutral situations, that's when you will be using a regular iron condor. So let's understand what's iron condor. So what's bearish iron condor, what's bullish iron condor? Bearish iron condor, you have a very good advantage with the IVs. So I'll be explaining about this also. So I mostly prefer this bearish iron condor if you have some idea about the direction. Okay, if you don't have any idea about the direction, if you have a neutral view, and that's when we normally go with the regular iron condor. So let me start with the explanation of this iron condor. Before that, let's look at Bitcoin, where it is standing now. So if you see here, yeah, this is Ethereum trade which is going on. So this trade I have taken once I got the breakout of 200 EMA. So here's where here this was the resistance, and this was a resistance at 200 EMA. So once I got this breakout, and after this there's a breakout candle, and then you can see there's a retracement which came to support level, and then this is where I took the entry. But then the market came down from there, Ethereum came down, and I'm looking to average at around this level. So if it comes to this level, I can average. We are trading the perpetual futures which do not have an expiry. There's no time decay also, so as much as I want to hold, I can hold, and I'll be looking to add some here also. So I have placed an order here, I'll be looking to add here also. So I'll add at multiple levels, and that's how I'll slowly accumulate some positions in perpetual future. So if you're looking to trade options or futures in Delta Exchange, by the way, there's a Delta Exchange, you can open an account. I'll give the link in the description so that you'll get some discount in the brokerage also. Now, one more thing that I can tell you is if you're a scalper, there's an advantage here. They have extended that 15-minute window to 30 minutes. Like if you have entered a trade, and when you are exiting the trade, if you're exiting within 30 minutes, there's no charge for exit. It's free. After 30 minutes, there will be exit charge. But for scalpers, this is an offer there. So you can open an account. I'll share the link in the description. So now let's look at the Bitcoin. Where is it standing? It's now at 1,10,000. So my explanation will be based on this 1,10,000. Okay. So there's a current market situation that I'm explaining. So you have Bitcoin which is standing at 1,10,000. Now, if I'm explaining a regular iron condor, so market is at 1,10,000. So if I'm looking at a higher level to be on a very safe side. Okay, so I'm assuming that it's not going to cross 1,20,000 soon, maybe 1 month. See here, look at the premium that you're getting. You're getting good amount of premiums, and then you have, that's why we are now trading mostly in Bitcoin options. So the premium is very good. Now, if you look at when one day to expire, these are the kind of premiums that you're getting, right? So if you look at at the money, so you're getting 527 at 50 delta, right? And here also almost 500. So 1000 is what you're getting when just 24 hours is left for expiry. So that's crazy, right? $1,000, which in itself is almost 1 lakh. So anyway, that I'll discuss later. So here you understand you're taking this as a higher level, and the downside also you will go equidistant. So this is when you have a neutral view. This is a regular iron condor with equal distance 1 lakh. Okay. So 10,000 on upside and 10,000 on the downside. So what you'll do is you'll short a put here and you will short a call here. So what is this position? Now a call sell and a put sell, and both are out of the money, right? Call is OTM and put is also OTM. So what's this call? This is basically your strangle. Now when the strangle, you hedge for the protection. In the India market, you are using the hedge for margin benefit and protection. Here, using for protection to prevent overnight risk and everything, right? So, what you'll do is, you will be going further higher and you will buy a call. And similarly, here you will go further lower and you will buy a put. So this plus and minus I am showing for selling and buying, okay. So it may be like 1,05,000 and it may be like 1,25,000. So I'm just taking random numbers so that you can I can explain easily. So what we did, we created a triangle, we hedged it with protection. That's when it became the iron condor. So now we have 4 legs, right? And these legs are equidistant. That's what neutral iron condor. Now we need to discuss the bearish iron condor. So I hope this setup is very clear. What's iron condor? So what you're doing is, on the call side, you can clearly see this is one call spread, right? Buy call and sell call. Similarly, we have a put spread. You have a short put and a long put. So this is what you have already. So this is what regular iron condor. So if the market is staying in the range where you have sold like 1,20,000, this range, right? That's when you will be making the profit. So if the market is staying here in between this range, then you will be making profit and with theta decay. So here the advantage that you're getting is mainly the theta decay in triangle. So the standard iron condor basically in low volatility scenario, time decay based income you will generate. But the problem is, sometimes if there's a breakout, then the risk is higher. So that's why I'm going to talk about a different approach here, a bearish iron condor. So for example, assume that it went to like 1,20,000, okay. It went to 1,20,000. So you know that the market has already moved this much and now it's time for maybe a cool off or maybe a small dip to 1,10,000 or 1,15,000. But it's now staying at 1,20,000. But you're not expecting it's going to give a breakout from here immediately. You're expecting it may go sideways. It may slightly go down, a cool off, and then can give a breakout. It's not going to crash. You're not expecting that. You're expecting it is overbought, right? So RSI is like 80. So it's overbought or overstretched. So you're expecting the market may calm down. In this scenario, what you can do is, so here, if you want to go with regular iron condor, what you'll do, 1,30,000 you sell a call, 1,10,000 you sell a put. But here, you're not doing that. Here, when you're selling a call, you're not going out of the money. What you'll do is, you're selling a call, shorting a call, that's at the money. Okay, because you're expecting it's going to go down from here. So either at the money, or if you don't want to take this much risk, we don't want to go far out of the money. We may be one step out of the money, like 1,22,000. So let's say you're selling it at 1,22,000, right? So this is going to be like 40 delta. So here you're going with 40. Either you can go with at the money if you're okay with that risk. But if you want to be some more safe, like 40 delta, earlier you were going far out of the money, maybe 20 delta or 10 delta. That's where you were selling the call. But now you shifted your call to close to this spot price. So what will you do with the put? Put you will slightly lower because you know the market is going to slightly go down. So you may keep it something like 1,15,000 or 1,14,000 like that. So what you can see here is it's not equidistant from the spot. Right? What spot? Spot is 1,20,000. So either it could be ATM, even if it is OTM, it's just 22,000 points. But here you can see it's around 6,000 points difference. So it's not equidistant. So this is what bearish condor, bearish iron condor. Because your view is bearish, so here you have a bias on the downside. So this is how you will be building a bearish iron condor. So I hope this is very clear. I hope you understood what we are discussing. So now the next portion is, let's understand why this works. See, in normal scenarios, when you see in case of put options, see, put IVs are always higher than the call IV. So that also will actually help you because the traders normally pay higher premium for the downside protection. So someone holding Bitcoin, so if he want to protect that from a crash, a major crash like what happened on the liquidation day, right? So what he'll do, he'll buy a put and he'll protect. So traders normally, like we are holding shares also, we'll do the same. So we'll buy the put option to protect from any crash. So traders normally pay high premium for protecting the downside risk. That's why when you get a red candle, the follow-up candle, the put premium spike very higher that you won't see in case of call. Now, so here you will get advantage both in terms of delta and because the call will come down. So you sold almost at the money. So delta advantage, and you also get advantage of theta from both call and put. Earlier, since it's equidistant, you're getting advantage only from theta decay, but that's not the case now. I hope this part is very, very clear to you. So you will be getting both delta and theta advantage. Now the problem is, what if this is going against you? That means you sold it at 1,22,000, right? So it's now at 1,20,000. So guys, I've just sold 1,22,000 or 1,14,000, but you always have a hedge. That's when it becomes an iron condor. Upside and downside you will be buying call and put. So 4 leg is here also. There are 4 legs. So one long call, long put, short put. That's when it become iron condor. So that 4 legs are here also like previously, but we just shifted the position to spot, especially the call strike. That's when we have a bearish bias. Okay, now suppose you sold it here. Now it's breaking and going to 1,25,000. Okay, now what is specialty of 1,25,000? It's all-time high of Bitcoin. And for multiple times it came here and you have seen good rejection. So now what you need to do is, you're getting trapped because your call C will increase, put will decrease, and put you will get profit. So what you need to do is exit this put which is giving you profit. For example, you collected a premium of 500. Now it would have become 200, maybe 60% decay you will get. So exit the put immediately and call your holding. When you are exiting the put, you don't want to exit the hedge because we are going to immediately add a put also. I'll discuss that. So just exit the profit one. Okay, now call. What you need to do is, it came to 80H, all-time high. You know there are multiple rejections coming from that level. So your view is still the same. It came to this level. It's a very good bounce. So overstretch or overbought, there can be a dip. It's still the same. But your timing was not correct. You should not have taken it at 120. So 125 is the right level where you can have a more bearish view. So what you will do is, there is where you need to average. Because if they are breaking out of 1,25,000, then it could be a very good move on the upsides. So when you sold 1,22,000, you might have bought the hedge at 1,25,000 or maybe 1,27,000. So in case of a breakout from that level, that hedge will protect you. So here's an opportunity for you to average. So what will you do? You will double your call exposure, which means you are going to sell one more call at 1,25,000. So this is at the money you're going to sell one more call. So now you have 2 short call and you have 2 long calls, which is hedge. So this is basically your hedge. Okay. One which you bought earlier. Now when you're shorting one more, you will have to buy one more at 1,30,000 like that. So random numbers I'm giving just for you to understand. Now after this, what you need to do is add one PE also. The one which you sold. So you need to add, that means again short one PE, but not at the previous level. It should be slightly higher level. So right now it's at 1,25,000. Earlier you are selling it at 1,15,000 something. Now make it to 1,19,000 or 1,20,000, that level. So this is what the adjustment that you need to do. Now 2 important points that you need to keep in mind is when you should not do. If you don't know the direction, if you don't have any idea about the direction, don't do. Then go with the neutral one. Only if you have a directional view, if you feel that the market is overbought or if you feel like it can revert, that's when you will do this. Second, don't hold till expiry, because expiry near to that you will have the gamma blast. Don't get exposed to the gamma blast. Whether you are trading Nifty or Bank Nifty, don't get exposed to that. Okay, so this is what I want to discuss. I hope you got some idea. Thank you so much. I'll see you in the next session. Thank you guys.